Not meant to be an insult, but a change of mind, because the typical boomer investment strategy of index funds has diminished. What worked the last 30 years will not work the next 30 years. I keep saying this. Now, if you've seen any of my previous videos here, go check them out, because I talk about how the system is changing, how the timeline has shifted, how our typical way of investing continues to change. And here, I'm going to break down something for typical traditional investors on something that might be important to look into if you want more growth going into the next 20, 30, 40 years when it comes to your retirement or your investment strategies. Now, this right here is me investing in particular stocks instead of index investing. And as you can see, they're outperforming by a long shot. This is me getting into that, getting out of indexes over the last year and seeing the growth and potential growth of that. Now I'm going to break down the numbers of what this looks like. Take it as you want. Like I said, it's not financial advice. You should look into it and do your own research on your own, even though I'm going to break some numbers down here. So let's talk about it. I personally think if you are a traditional investor, you're better off right now, especially with inflation and hedging the value of the dollar and the amount of money printing that's going to happen over the next few years, that you should invest in the Magnificent Seven, which pretty much takes over a large percentage of the growth of the index funds anyways, versus a traditional index fund investing. Now, it's just as easy as investing in index funds. And if you want to take a look at the ones that I got into, Amazon, Google, Nvidia, and Tesla, they are outperforming by a long shot. Now, yes, the S&P, the index, is doing really, really good compared to its typical 7 to 9% growth per year at about 12, 13% already year to date. But you could have double the growth in the Magnificent Seven. Now, if you have questions about what the Magnificent Seven is in the first place, it pretty much takes up 60 to 80% of the growth of the actual S&P 500. So this growth is pretty much covered by these and these stocks of the Magnificent Seven. Magnificent Seven stocks are US tech-focused stocks in Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. Now, with AI taking over as well, a lot of these big companies are also in the race for AI. So if you believe that AI is going to grow in something like Google that has Gemini, right, and Meta getting into AI and crypto, all of these stocks are likely going to grow if AI and technology continue to grow and continue to be a part of the economic powerhouse of the United States. So if you're curious about what Magnificent Seven means when I say that, it's considered these stocks. Now, yes, there are some outliers that have more growth as well, but they aren't considered in the Magnificent Seven. But what I'm trying to say is you're better off having growth in those stocks and investing in those stocks as your own index of stocks you choose versus just an S&P and just an index. Because when we're at 7, 10, 15% inflation, and that'll continue to go up, that 12% isn't actually going to be much growth when it comes down to the inflation. Now, check out those videos like I talked about. I'll explain things a little bit further there, but let's actually break down some of the numbers when it comes down to these types of stocks for you to think about. So when it comes down to it, when you look at the Magnificent Seven, the 10-year return on Amazon, for example, was 866%, about 20% plus per year. And that's pretty standard across a lot of those Magnificent Seven stocks. So would I prefer a couple 100% over a span of 10 years, even if it's not 866%? Yes, I'd prefer that over, let's say, 100% over 10 years in the S&P. Now, yes, the reason why the S&P is doing well is because of those stocks, but also we've been pretty much in an all-up scenario when it comes to stocks and when it comes to the market. But if we dive a little bit deeper there, let's run a plausible average. So I'm giving you guys time when I'm doing these numbers on a 20-year growth scenario. So let's say you have 100K invested, 200K invested, 300K invested, 400K invested. For example, I'm starting this at, let's say, the age of 30. So let's say you get 6 to 8 years of working, you're able to save, let's say, 10 to 20 grand a year and invest that. I'm giving you guys options, whether depending on what type of career you have, you might be able to save a lot more than other people. If you were to take that return in the Magnificent Seven, if you were to take that at 100,000 and it's only a 10% average return per year, you have 20 years later, $653,000. Now it's a 15% return, which is pretty much between 15 and 25%, is pretty much the majority of all the Magnificent Seven stocks average return over the last 10 years. So if we take that into account, right, 10% is very, very conservative as it still outbeats the index fund. But if it's 15%, you almost have double the amount. Look at the massive difference in just a 5% return. 10% to 15%. It almost doubles to triples every 5% over a long period of time. So even at $100,000 of investing without even adding more to that, 20 years later, at age 50 from 30, you'd have 1.6 million. If it's higher return, right, and you mix and match different Magnificent 7 stocks, you almost have triple that return at 4.5 million. And a lot of people like to be sitting at this, but like I say, cut this in half at the time you're retiring, and that's how much the value would actually be. So we actually have to take a little bit more risk in investments, especially if you're younger, because of inflation, because of the devaluation of the dollar, because things are only going to get more expensive as we get older. Now, if you do 200,000, 300,000, 400,000, as you can see, right, those numbers look way, way better than a typical 8% return on an index fund. And they're still safe returns. The Magnificent 7 are pretty much companies that cannot fail at this point. They're going to be companies forever. Now, will those returns continue at that amount? Probably not. It would be great if they did, but still at a conservative 15% when the last 10 years, the data shows us that the average return is between 20 and 30% per year. With a lot of them, you still have a conservative rate of a really good large number when it comes to investing. So think about that. Now let's move on to something else. Let's say we approximate a 5, 10, 15, 20 year annualized return. Now, if we compare that with the typical average return on those stocks, like I was just talking about, on average, 5 years, the last 5 years, they're all over 15%. Now, NVIDIA is obviously a little way outside of that realm, but we have 12.5% at Amazon. We know that Amazon is going to continue to be a company and they're not going to fail. They're too big to fail, but everyone else is above that 15% marker on the 5-year return, even higher on the 10-year return. If we look at our average, when it comes to the S&P, we have higher returns, almost double the amount of returns. And if we look at the numbers of just a 5% more return, I mean, it's double what you're gonna get. This is pretty much ends up being the number for the S&P 500. So if we take a look at that, we go, okay, let's compare the S&P at a non-conservative number of 10%, when it's typically 6 to 8%, that's $673,000 with a $100,000 investment. 200,000, 1.35, 300,000, 2.02. Magnificent 7 at just 5%. You can see almost double, if not more than that. On a 20% horizon, you literally have a 5x. The numbers are there. The S&P grows about 6 to 7x in a span of 20 years. But if you take the Magnificent 7 at a 5% more clip, doubles the amount of growth, 20%. If they're good growth, even more, that's pretty much the average of those stocks, you're looking at a 38x, you're looking at a 8 to 10x on that, which is insane. Just by transitioning the typical boomer model, which is investing in indexes because it's easy, it's just as easy to invest in the singular stocks and then spreading it out between those stocks for more growth. So the reason for this video is I believe that we are going through some crazy times right now. I believe that we are going to continue to print money. And if you watch these videos, you'll understand where I'm coming from, where inflation is only going to get worse. They're only going to put more money in circulation. So the value of your dollar goes down and the purchasing power goes down and things become more expensive. So I'm giving you guys an idea if you're someone who is very conservative with your investing, if you're someone that is investing a small amount over a period of time to hope that you have $1.5–2.5 million, I'm giving you another option to be self-aware about and to crunch the numbers yourself as I did here to show you that there's more opportunity. Because right now, if that were the case, if my thesis is right, which I think it will be, even though this isn't financial advice, the value of your dollars, you want to be able to make more money because it will go a much longer way in the future 20–30 years. What worked in the last 20–30 years will not work in the next 20–30 years. So we have to be a little bit more aggressive. We have to understand timelines. We have to understand the growth of what's actually taking over the indexes. And hopefully this gives you a better idea of how you can think about at least a percentage of your portfolio to invest in. And as always, guys, I talk about credit, finance, business credit, loans, banking. If you are someone who is interested in accessing credit, accessing financing, being able to start a business, build a business with the bank's capital, I think we're running on a low amount of time within 7 years that you won't have access to that, maybe within the next few years, then reach out to me, schedule a link down below if you want to learn how to travel for free or if you want to learn how to access 0% capital and loans to be able to grow or scale your business or utilize that to invest, then reach out to me in my links down below. So as always, let me know your comments down below. Let me know your thesis, what you believe in terms of investing. Feel free to drop them down below. Hit like, hit subscribe. Hopefully you enjoyed the video, and I'll see you guys on the next one. Peace.